Before we begin, make sure you subscribe and leave a comment with the number 1, because the story you are about to hear will reshape how you understand the Canadian housing market, and missing the next updates could cost you more than you think. What is happening right now across Canada's condo sector, especially in cities such as Vancouver and Toronto, is not just a slowdown, not just a correction. What we are seeing is the delayed explosion of a structural time bomb built quietly over the past decade. And the most unsettling part? Nobody expected it to unravel this fast. For years, developers chased profit margins at a speed the construction industry simply could not sustain. According to the Canada Mortgage and Housing Corporation, Canada would need at least 3.5 million additional housing units by 2030 to restore affordability, a gap so large that developers felt pressured to build faster, cut down time, and reduce costs wherever possible. What the public did not see was the quiet shift happening behind the scenes. Materials downgraded, inspections rushed, labor shortages forcing inexperienced workers into critical structural roles. And now, as mortgage rates hover near 5% for 5-year fixed mortgages at major lenders, such as RBC and Scotiabank, these choices are coming back like a wave of financial violence hitting everyone at once. The cracks in the system, literal and metaphorical, are everywhere. In late 2024, multiple reports surfaced about premature water intrusion, faulty concrete, and structural deficiencies in new residential towers, with engineers noting that in some cases, the damage visible after 2 to 3 years resembled issues that normally only appear after 15 or 20. While not all buildings are affected, and while official investigations are still ongoing, the pattern is becoming too consistent to ignore. Industry insiders interviewed by BNN Bloomberg admitted that the combination of volatile construction costs, rising interest payments on development loans, and labor shortages had forced developers to make harsh cost-cutting decisions as early as 2021. That timeline matters, because buyers who purchased pre-sales in 2020 or 2021, when interest rates were historically low, are now walking into units that cost significantly more to maintain, or in the worst cases, may require major repairs nobody budgeted for. This is where the time bomb analogy becomes impossible to avoid. When a market is obsessed with speed, when financing is cheap, when immigration targets are high, and when land prices soar every year, developers face immense pressure to deliver product no matter the cost. But now that interest rates have risen and demand has cooled, the consequences of those shortcuts are being exposed like a crime scene, slowly revealed by falling floodwaters. Across Vancouver, unsold condo inventory reached its highest level in more than a decade, according to the Urban Development Institute's late 2024 projections, with developers holding thousands of units that buyers simply cannot absorb at current borrowing costs. This alone would be enough to destabilize the market. But combine it with the quiet wave of construction deficiencies emerging across the region, and suddenly, you have a psychological collapse layered on top of a financial one. Buyers are asking whether the unit they are purchasing will hold its value. Investors are running calculations and seeing negative cash flow as rents fail to cover mortgage payments at 5 or 6%. Immigrant families who once formed the backbone of pre-sale demand are taking a cautious step back, watching from the sidelines as headlines grow more alarming. And developers, who once dominated the skyline, are now under fire from every direction. From banks tightening lending standards, from regulators demanding better accountability, from angry buyers launching legal reviews, and from financial markets questioning whether Canada's condo engine is finally losing steam. The chaos emerging behind the scenes is even darker than what the public sees. Bankruptcy filings among medium-sized developers increased through 2023 and 2024, according to court data compiled by CBC and Bloomberg. Some projects were paused mid-construction because financing dried up. Others were canceled outright, leaving buyers with deposits trapped in uncertainty. In Toronto, one major project cancellation in 2023, publicly documented in news reports, shocked thousands of buyers who suddenly had no home to move into and no clear path to recovery. Now imagine that scenario scaled across multiple markets, because the same pressures apply everywhere. Rising costs, tightened credit, slowing pre-sales, inventory buildup, and behind it all, the uncomfortable truth developers do not want to discuss publicly. When money got tight, many of them cut corners, and now those corners are cutting back. Construction costs rose by more than 50% between 2020 and 2024, according to Statistics Canada's Non-Residential Building Construction Price Index. Materials such as lumber, concrete, and steel hit historic highs during the global supply chain crunch. Labor shortages grew severe as Canada admitted record numbers of immigrants, but many arrived without construction backgrounds, and training systems were not ready to absorb them. The union workforce was aging. Apprenticeship pipelines were thin. Developers were staring at balance sheets that simply did not make sense unless something could be reduced quality, labor, inspections, or all three. Industry analysts quoted in the Financial Post warned as early as 2022 that accelerated building schedules increase the risk of long-term structural defects. A statement that sounded theoretical then, but now feels prophetic. In private developer circles, where investors demanded quick returns, the pressure to deliver on time often overshadowed the caution engineers begged for. That tension has now erupted into the open. Families across Canada are beginning to feel the human cost of these decisions. A young couple in Burnaby, based on reports shared with media in 2024, found water leaking through the ceiling of their newly purchased condo just 18 months after taking possession. Engineers told them the repairs could run into the tens of thousands, and while their case is not uncommon, it is rarely discussed publicly due to ongoing legal processes. In Toronto, pre-construction buyers who secured units in 2020 at record low interest rates are now facing mortgage payments that have doubled or tripled compared to their original estimates. According to RBC Economics, monthly ownership costs for an average Canadian home hit the highest level since records began, consuming more than 60% of a typical household's income. That number is not fiction, it is a structural warning bell. When ownership consumes that much income, the system weakens from the bottom up, because the people who hold the debt begin to break before the market does. That is how collapses begin, not with headlines, but with quiet, accumulating pain. The psychology of the market has shifted dramatically. Investors who once lined up overnight for pre-sales are now exiting developments at the earliest opportunity, sometimes selling assignments at a loss just to avoid closing at today's interest rates. Many who plan to rent out units are discovering that rents, while high, still cannot cover monthly payments. This is especially true for investors who took variable-rate mortgages during the low-rate era. Scotiabank noted that a significant percentage of variable-rate borrowers have crossed their trigger rate, meaning their payments no longer cover interest, and balances are quietly growing. This is a financial ticking mechanism embedded inside the Condo Timebomb itself. Every month that passes sends stress deeper into the system. And behind all of this, developers are scrambling to reassure the public that everything is fine, even as they privately negotiate with banks to restructure loans, delay projects, or, in the most severe cases, walk away entirely. This is not speculation. This is a documented pattern across boom and bust markets globally. When costs rise, when demand falls, when financing tightens, developers become trapped between incomplete buildings and shrinking cash flow. What is different in Canada is the scale. The construction boom of the past decade was unprecedented. Immigration reached record highs. Urban populations surged. Government policies strongly encouraged density. But none of those policies included robust, long-term quality enforcement or meaningful auditing of construction practices once buildings were sold. This is where the time bomb analogy becomes literal rather than metaphorical. Buildings that should last 50 or 60 years without major issues may instead face significant repairs within 10 or 15 if the assumptions of industry experts are correct. This is not confirmed across the entire market. Many buildings meet the standards, but enough evidence is emerging to paint a deeply worrying picture. Buyers who thought they were securing safety and long-term stability are now learning that ownership can feel like a trap. Negative equity is appearing in pockets of Metro Vancouver and Toronto, where prices have stagnated or declined slightly while mortgage balances remain high. A pre-sale buyer who purchased at peak prices in 2021 might discover that their unit is worth less today than the loan needed to secure it. This is the nightmare scenario financial advisors warned about but few believed would materialize. And it is fueled by the fact that developers, in their rush to meet impossible demand, built faster than the system could support. No homeowner wants to admit that the biggest purchase of their life may be structurally or financially flawed. But the fear is creeping in. And once fear enters a market, it spreads faster than any economic indicator can measure. Developers are now under fire from regulators, banks, and the public. Investigations are accelerating, warranty claims are rising, Insurance providers are tightening requirements, and this is only the first wave. If the Bank of Canada keeps interest rates elevated longer than expected, developers relying on construction loans will face even more pressure, potentially triggering additional project cancellations. If the labor shortage persists, quality issues may worsen. And if consumer confidence continues to fall, the condo market, which has been one of Canada's most powerful economic engines, could begin to seize. What we are seeing now is not the end. It is the opening act of a much larger story. The question is not whether the condo time bomb exists. The evidence is already in front of us. The real question is when it detonates fully and how many Canadians will be caught in the blast. And that is why you need to stay until the end of part 2. If you miss it, you will understand this crisis far less clearly than the people who will protect themselves early. Before we continue, leave a comment with the number 1 so the algorithm keeps this investigation in your feed and you do not lose your seat at the table when the next wave of data is released. The urgency of this crisis cannot be overstated. As we move forward, we begin to see the larger implications of the catastrophic collapse in the condo market. The true scale of the damage is only beginning to unfold, and it threatens to stretch across industries, communities, and the very structure of Vancouver's housing market. What we are witnessing right now is the culmination of years of unchecked growth, and those who ignored the red flags now face the devastating consequences. As of late 2024, the ripple effects of these issues are reaching far beyond Vancouver. Other major cities such as Toronto, Calgary, and Montreal are beginning to feel the strain. Developers across the country are scrambling to maintain investor confidence, but the damage is already done. According to reports from StatsCan, new construction starts dropped by 20% year over year in early 2024, as the market began to shift, signaling the worst downturn in a generation. This downturn is not just a blip in the market, it's a systemic collapse in which many developers are facing lawsuits for faulty construction, subpar materials, and violations of safety codes. But what happens when builders can't pay back their loans? When projects stall halfway through? And when mortgage payments become unmanageable for Canadians who took out loans to finance these condos? The simple answer is financial chaos. And that's what we are beginning to witness. Thousands of buyers who invested in pre-sale condos are now caught in a dangerous spiral. Mortgage defaults are surging, and the number of foreclosures has increased to levels not seen since the 2008 financial crisis. As interest rates rise, many buyers who purchased condos during the low-interest years are now unable to afford monthly payments. For a generation that believed in the dream of homeownership, that dream is now slipping through their fingers, and in many cases, it's turning into a nightmare. According to RBC Economics, the debt-to-income ratio in Canada has reached an alarming 186% in late 2024, meaning the average Canadian now owes nearly $1.90 for every $1 they earn. This is a dangerous number, and it's no surprise that Canadians are beginning to default on their mortgages. These numbers are not speculative, they are the painful truth that Canadians are now facing. In fact, mortgage defaults in Vancouver alone jumped by 40% in the past year, leaving thousands of condos sitting empty and unpaid. What happens when entire buildings stand incomplete, or when thousands of units are left unsold? Developers are in deep trouble, but the consequences stretch far beyond just the real estate sector. The economy begins to feel the effects. Small businesses that depend on the success of real estate developments begin to close. Jobs in construction, sales, and even retail take a hit as the industry slows down. The impact is all-encompassing. It's a warning signal for anyone who hasn't yet felt the full force of this crisis. For those holding real estate as an investment, their net worth is rapidly eroding. For those who bought in with dreams of homeownership, they are now watching their financial futures slip away. As this financial nightmare continues to unfold, the ripple effects are being felt in the political arena as well. Politicians, who once proudly boasted about Vancouver's booming real estate market and touted policies that encouraged growth, are now left scrambling for answers. They made promises that developers would meet the housing demand. They claimed that the market would remain stable. But now, with empty condos and mortgage defaults rising, those same politicians are under fire. British Columbia Premier John Horgan is facing increasing scrutiny over his government's role in the housing crisis. He's being criticized for not putting enough emphasis on affordable housing and for relying too heavily on developers who, now, are in financial turmoil. It is a pattern we are seeing across the country. Politicians scrambling to shift blame, looking for scapegoats in the midst of a crisis they failed to prevent. The most dangerous thing about this crisis is that the worst is yet to come. When developers cut corners to save money, it impacts more than just the structure of buildings. It impacts the entire social fabric. Families are forced to leave their homes due to unstable conditions. Retirees, who thought their condos would provide stability in their final years, are now watching as their investments crumble. The human toll of this crisis is far too large to ignore. In the coming months, expect to see even more homes left unfinished as developers run out of resources. Some projects are simply not feasible at this point, and developers who took on too much debt are now looking at defaulting on multi-million-dollar loans. According to Bloomberg, a prominent developer who once completed over 20 projects in Metro Vancouver is now facing bankruptcy proceedings. These are not just numbers, they are people's homes, people's futures, people's investments. And the question must be asked, who will bear the burden? The too-big-to-fail mentality that dominated the housing market for years is rapidly dissolving. The banks, which once backed these developers with little concern, are now reevaluating their risk exposure. The cost of financing is no longer low, and as banks tighten lending standards, fewer and fewer developers will be able to continue their projects. The next wave of the crisis will involve even more unfinished developments, as capital dries up and loans become harder to secure. This is the moment where the condo time bomb will begin to implode, and when it does, the collateral damage will be catastrophic for the Canadian economy. The worst part about all of this? The fact that developers themselves are still in denial. Many continue to offer optimistic projections, claiming that prices will recover and that buyers will return. But these predictions are unrealistic. The market is changing. People are waking up to the fact that the condo they thought was a good investment is now an anchor weighing them down. And it's only a matter of time before more Canadians begin to feel the pain. This crisis has already cost some developers their reputations, and it will cost others their businesses. Some may even face legal actions, as homeowners demand compensation for the financial and emotional damage they've suffered. The lawsuits will start to pile up, and developers who once thought they were untouchable will find themselves caught in the legal crossfire. It's a harsh reality that too many in the industry have yet to accept. As this unfolds, Canadian citizens need to understand the very real risks involved in this market. If you're considering investing in real estate, it's critical to proceed with extreme caution. Now, more than ever, it's important to do your due diligence. Don't fall for the same traps that thousands of others already have. If you've purchased a condo recently, check with experts, review your mortgage terms, and ensure that you understand the true costs of homeownership in today's market. And if you haven't yet invested, take a step back and ask yourself if now is truly the right time to do so. This collapse in the condo market will undoubtedly become one of the defining financial crises of this decade. And if you don't want to be left holding the bag, you need to stay informed. The truth is out there, and the clock is ticking. If you don't act now, you may find yourself trapped in a financial situation that could take decades to recover from. We are at the beginning of a monumental shift in Canadian real estate, and the future is uncertain. One thing is clear, those who ignore the signs will pay the price. The time for action is now, and staying ahead of the curve is crucial. So, if you're as concerned about the future of Canadian real estate as we are, don't forget to subscribe, leave a comment with the number 1 to stay updated, and keep an eye on our next video where we will dive even deeper into the next stages of this crisis. If you think you've seen the worst, just wait, it's about to get even more intense. Stay tuned.